Welcome, everyone. We're pleased that you have joined us for today's webinar titled What Every Financial Professional Needs to Know About Trusts, Part 2. The webinar will last approximately 15 minutes, and at the end you will be given an opportunity to receive supporting materials by email, free of charge to you. You will also be told how you may email questions related to today's content to the presenter. Today's presenter is Jennifer Lawler. Jennifer joined the Advanced Underwriting team in October 2014. Before joining Advanced Underwriting Consultants, she spent 6 years working for a tax and estate planning group. While there, she worked extensively on tax return preparation, estate planning, and assisting clients with their tax needs. Jennifer will draw on her legal, tax, and practical experience for today's webinar. And here she is.
Hello, everyone. Thanks for joining us today. As we discussed last week, trust can be a very important estate planning tool. Financial planners should have a working knowledge about trusts in order to better serve their clients. In last month's webinar, we discussed when and how trusts are created, typical trust structures, how trusts are administered, and some common types of trusts and their primary purpose. In this month's webinar, we will discuss trust taxation, the role of financial products in trusts, and common misconceptions about trusts. Trust taxation can be very complicated, and depending upon the trust, can include several different types of tax. While we cannot accurately predict all of the tax results that may arise, we can talk about these different types of tax generally and how they might impact a trust. Trusts can be subjected to income tax, estate tax, gift tax, and even generation skipping tax. As you'll notice, the top federal bracket of 39.6 is the same for a trust as it is for an individual. However, the amount of income it takes to reach that threshold is much lower for a trust than it is for an individual. In 2017, a single taxpayer would have to have taxable income over $418,000 before reaching that 39.6% bracket, whereas a trust only needs more than $12,500 worth of taxable income to reach that high tax bracket. A trust can easily get into this high tax bracket with very little income. Luckily, not every trust will be liable for tax based upon the table rates. Some trusts pass through the income tax result to the trust grantor. This is most commonly seen in living trusts. The grantor is responsible for the income tax result rather than the trust, and has to report the taxable income on their individual tax return. Other types of trusts pass the income tax result on to one or more trust beneficiaries. In general, a trust will be liable for income taxes at trust rates if the trust is a non-grantor trust and the trust income accumulates within the trust, meaning that it is not paid out to the beneficiaries in the year the trust receives the taxable income. Let's talk a little bit more about grantor trusts, where the trust grantor or trust creator is taxed individually for the trust. As we mentioned earlier, this is most commonly seen in revocable living trusts, but can also be useful tools for other types of planning. Trusts that would otherwise be non-grantor trusts can be drafted to be treated as a grantor trust for tax purposes. These types of trusts must include special language that typically reserves some type of limited power for the grantor. We commonly refer to these trusts as intentionally defective grantor trusts, or IDGTs. This strategy is often used when creating irrevocable life insurance trusts, or ILITs. This strategy allows the grantor to be taxed for the trust income during life while still excluding the trust assets from the grantor's estate for estate tax purposes. As we touched on earlier, if trust income is distributed to one or more trust beneficiaries in the same taxable year it is realized, the beneficiary is responsible for the tax associated with the income. A trust can also be taxed to the beneficiary if the trust is properly drafted. Internal Revenue Code Section 678 allows a beneficiary to be considered the owner of the trust for income tax purposes if the beneficiary has the right to withdraw the assets from the trust but does not do so. While the IRS has in some instances approved this treatment, trusts specifically drafted to be beneficiary tax trusts are not very common. Gift tax should always be considered when discussing trusts. Anytime ownership of an asset is changed, gift tax implications should be considered. Transfers to trusts can and often do have gift tax implications. Typically, transfers to revocable trusts are not considered gifts because the grantor has complete control over the assets within the revocable trust. However, transfers to irrevocable trusts often do have gift tax consequences and should be evaluated. If a grantor retains control of the assets, the gift is considered incomplete and therefore is not subject to gift tax. For 2016 and 2017, the annual federal gift tax exclusion is $14,000. Any individual can give up to $14,000 to any other individual without the need for a gift tax return. In order to qualify for the exclusion, the gift must be one of present interest. In order for a gift to be a present interest gift, the gift receiver must have immediate access to the gift. Gifts to trust are really gifts to trust beneficiaries and can be made as present gifts if the trust beneficiaries have the ability to access the gifts in the trust. This is often accomplished through crummy powers. Crummy powers allow the trust beneficiary the ability to reach into the trust and access the trust assets upon request. Gifts of future interest do not qualify for the exclusion. If a gift of a future interest is given, the gift giver must file a gift tax return and use some of their lifetime exemption. In 2017, the federal estate tax exemption amount is $5.49 million per person. Married couples have a combined $10.98 million for their estate tax exemption. If a grantor retains significant control over trust assets, the value of the assets will be included in her estate for estate tax purposes. The highest federal rate for estate taxes is 40%. Because of that high rate, incorrect planning can greatly diminish an estate. Generation skipping tax is an extra tax imposed on gifts given to grandchildren or gifts given to any family generation more remote than children, such as great-grandchildren. The current tax rates and exemption amounts for generation skipping tax are the same as the federal and estate tax exemption. People often get confused about the purpose and effectiveness of trusts. As we've mentioned, some of the most common trusts used are revocable living trusts. So that's where we'll start when discussing common trust misconceptions. People often mistakenly think that they need a revocable trust in order to save on estate taxes. While revocable living trusts can be an effective way to transfer wealth, they do not save on estate taxes. Assets within a revocable living trust will be included in the grantor's estate for estate tax purposes. Another common misconception is that revocable living trusts can be used for Medicaid planning. While some irrevocable trusts can be used to effectively plan for Medicaid, revocable living trusts do not provide that advantage, and assets within one will be subject to Medicaid spend-down. Likewise, revocable living trusts will not protect assets from the grantor's creditors. After creating a revocable living trust, people often think that they need to retitle all assets so that they are owned by the trust in order to avoid probate. But assets with named beneficiaries, such as life insurance, annuities, and retirement accounts, already avoid probate. One of the biggest drawbacks to irrevocable trusts is that they are irrevocable. Even if the trust creator's intentions have totally changed, they can still be very hard to undo and require the help of an experienced attorney. Lots of products nowadays have added benefits such as long-term care or chronic illness riders. Individuals want the benefit of estate tax exclusion and the ability to access the added life insurance benefits. But unfortunately, it doesn't work that way. In order to be effective for estate tax exclusion, a trust must not prevent the insured to have any right to the assets within the trust. Finally, we'll discuss some misconceptions about charitable trusts. When people hear the term charitable remainder annuity trust, or CRAT, they automatically think that the trust must invest in an annuity. But a charitable remainder annuity trust is called an annuity trust because of the way the income stream is paid to the grantor rather than what produces the income stream. While life insurance is typically used in conjunction with charitable remainder trust planning, the insurance itself shouldn't be owned by the charitable remainder trust if the purpose of the life insurance is to replace the wealth given to the trust. It should be owned separately and probably by an ILET. Clients mistakenly believe that having any kind of trust-owned life insurance policy will exclude the policy from the insured's estate. But as we discussed earlier, if the grantor has control over the assets in the trust will be included in the grantor's estate. An irrevocable trust is needed to avoid estate tax inclusion of the death benefit. It's up to life insurance professionals to help their clients understand these distinctions. For the role of annuities in trusts, a non-qualified deferred annuity owned by a trust raises several tax questions. Under Internal Revenue Code 72U, non-natural owners of non-qualified deferred annuities have to recognize the contract's growth as taxable income in the year it is earned. The IRS has ruled that an entity acting as an agent for a natural person can enjoy deferred growth, the same as a natural person. But unfortunately, the IRS has given us little guidance on when a trust acts as an agent for a natural person. From IRS rulings, we are pretty certain of the following rules. Grantor trusts and non-grantor trusts that are for the benefit of one real person are considered agents for natural people. Charitable remainder trusts and trusts that have one or more businesses as beneficiaries are not considered to be acting as agents for natural persons. It is still unclear whether trusts that have multiple beneficiaries or trusts where the annuitant is different from the grantor would qualify as agents for a natural person. It is prudent to act on the side of caution when an individual insists on a trust-owned annuity. And as always, agents and individuals alike should speak to their tax professionals about the impact of the non-natural owner rule anytime they are considering a trust-owned annuity. As we've discussed, trusts can offer several benefits. They allow assets to be excluded from a taxable estate. They offer a way for the trust creator to control assets even after death. Assets within a trust generally avoid the probate process. But if a trust is entered into without full knowledge and counsel, there can be unwanted and unintended tax consequences. It is always important to seek the advice of a tax professional when dealing with trusts. Thanks so much for joining us and listening in today.
Thank you, Jennifer, and thank each of you for joining us today. As a reminder, if you would like to receive supporting materials, feel welcome to email us at asktheexpert@advancedunderwriting.com. That's asktheexpert, all one word, at advanced with a D, underwriting with an ing.com. You may also email questions related to today's webinar to the presenter using the same email address. Feel welcome to join us for the next webinar on the first Wednesday of next month, May 3rd, at this same time. Next month's webinar will be titled The Hidden Advantages of Life Insurance. You can also find an archive of past webinars on our YouTube channel. Finally, for more information about the services that Advanced Underwriting Consultants offer, including phone consultation and newsletter licensing, feel welcome to contact us at 615-224-1291. That's 615-224-1291. Thanks again, and best wishes for continued success.